Australia falling. We have a guest on the show tonight that has a very good insight of the Australian housing market. That's going to give us a good understanding on what is happening. It is my man Andrew. Andrew, based out of Sydney. How are you, my brother?
I'm very good. How are you?
It's good to have you on. Okay, speak your mind, brother.
So basically, I've been watching Sydney since probably, since at least before the global financial crisis back in '07. I was just in high school then, which is, pretty, it was pretty topical because I was studying economics at the time of the GFC. And our then Prime Minister, Kevin Rudd, introduced a massive stimulus package, basically to try and stave off the recession. But we also had a thing called the First Homeowners Grant, which was increased significantly. So we used to have a First Homeowners Grant, which is like a, first homeowners can't buy, so we're going to give you a little bit of money to buy into whatever housing you want.
When did that come out?
So that was '08. That was, I think it would have been like just after Lehman had collapsed.
Okay.
That came out.
Okay.
And then after that, so you've basically had a rundown in interest rate. So our interest rate in September of '08 was 7.25%.
That's a very healthy.
So it was high.
Yeah, it's a very healthy rate, though. Very healthy rate.
Yeah, it's healthy. Yeah, it was healthy. The interest rates were trending up from like '04 to '07, and then kind of went flat, and then it came down in the GFC. From roughly, when was it, like '07, '08, it was 7.25, and then came down to like 2.5%.
Yes.
And then went back up when we had a mining boom when China started spending a bunch of money on our commodities.
That was in Perth, right?
Yeah. So it wasn't just Perth, it was Western Australia in general.
Okay.
And you also had a lot of it in regional Queensland. So you had the coal mines in Queensland, and you had the iron ore mines in Western Australia.
Okay, yes.
So that's out of Port Hedland in Western Australia, and places like Moranbah and Emerald and stuff like that in Queensland. So that's like so it's like central Queensland sort of thing.
Okay.
But a lot of that is to do with the wholesale price of commodities. Like if you're having a mining boom, it's obviously because you want to sell commodities as fast as you can because they're attracting a really high price in the wholesale market.
That's correct.
But yeah, the coal price has collapsed, the iron ore price has collapsed, and in those particular areas, you've had massive price declines from their peak, which was just after the GFC sort of thing.
Yeah. So
they all, in terms of like 2012, 2013 was their peak, and then in some of those areas, you've had price declines of like 80%. Yeah, but obviously, if you're in a seasonal town and it's very much dependent on one industry, then if that industry goes, then your town goes as well.
A lot of people are mentioning my town because it's a very heavy lumber town, right? It's very heavily based on soft lumber, right? Yeah. And a lot of people are saying, well, Mike, what will happen when the lumber... Well, I do...
But lumber isn't the same sort of thing. Lumber is used for a lot of things. It's not just building material. Like steel... I looked into this when I started seeing the steel price take off. Mm-hmm. Steel, globally, China makes up 50% of global demand for iron ore for construction purposes. So whether that's them building for the Belt and Road Initiative or whether that's them building ghost cities with apartments and things like that, that's definitely adding a stimulus to our economy because there's so much money coming in to buy commodities.
That's right.
It makes you look good for a short period of time, but if you don't address it long term, then you basically... It's like riding a wave of stocks and not getting out before the market tanks.
Right.
You watched it happen and you didn't really get benefit out of it whatsoever.
You didn't time the market correctly. That's correct.
Yeah, exactly. And I think there's always the argument of timing the market versus timing the market, but there's a bunch of different ways to try and actually see if there's something that you can get out of it. Like in Sydney, if you've got the 60% interest-only loans or something like that. Like, because on a nationwide basis, it was gotten to like 45% by the end of 2014.
That's a nightmare. That's an absolute disastrous nightmare.
It's ridiculous. And then of those, it's mostly investors. So if your investors leave the market, then your entire housing market is going to be filled with a bunch of people that have got interest-only loans they can't refinance.
Exactly.
Which is basically the situation we're in now.
Do you
And I saw
remember?
that coming. I saw that. So I know the regulation that came in that kind of got the ball rolling for that particular issue, and that was after a investigation into bank standards, but that was back in 2014, and that was called FOFA. So there was a bank investigation in 2014 called FOFA, which is the Future of Financial Advice,
Okay.
where they were looking at financial advisors rather than the entire industry, like banking, mortgage lending, brokers, superannuation, which is like our pension fund sort of thing.
Okay.
But yeah, that kind of started off a wave of regulations that started to come in slowly, but the enforcement was really bad. So you'd have a law, but it wasn't actually enforced properly. Like there's a law introduced by our equivalent of, well, what would it be? I'm trying to think of what would be the equivalent of it. So it's kind of like the SEC in the US, but I'm trying to think of whether it would be OSFI or something like that in Canada. I can't remember the exact regulator that it is. But we have a regulator for financial markets. And they introduced a law called RG209.
Yeah, we have CMHC. I think it's called CMHC.
Yeah, but that's for mortgage insurance.
It's your
That's
mortgage
not the same.
insurance. Okay.
Yeah.
You're talking about the mortgage rate. Oh, okay.
The
RBGV.
regulator for stock
Yeah.
market.
I know what you're talking about. I know what you're talking about. The US has one too. It just fails. It just.
US is SEC.
Yeah.
It's the SEC in the US. But our one is called ASIC, and ASIC introduced a law on the 1st of November 2014 called responsible. It's RG209, which is responsible lending.
Mm-hmm.
I'll just pull it up on my computer because I've looked at it a bunch of times. But yeah, it's one of those laws where it says the onus on the lender is on the lender for issuing a responsible loan. So you need to make reasonable inquiries about the person's financial situation, and all those sorts of things. So it's come out in the Royal Commission that basically has never happened.
And the Royal Commission was thrown into place 10 months ago now? 10 months now?
I was started in November last year.
Oh, okay, so...
Last year.
Yeah, okay.
But it started in February. February, March, yeah.
It was talked about in November, and then they actually implemented it in February, March. And
yeah, exactly.
I was thrown for a curveball when I saw the amount of garbage they threw on the books. It's phenomenal. Like anyone that walked in there to pay an electricity bill or a gas bill, sit right down. We got you approved for a mortgage. Like, are you serious?
Yep.
It's like
Yep.
I couldn't believe, but stretching the rules, and that's what happens when you start getting into commission only businesses where you get paid by the job, by piecework, right? And the more customers you could generate, the more. But then the dishonesty in so many people, and then what really pisses me off, I don't care if these people are liars. What upsets me is they're fitting customers with products they know that are not gonna, and giving them insurances and stuff on these junk loans, and then these customers and these people are on the hook for life for something that doesn't benefit them and it doesn't suit them. It's disgusting.
Yeah. Part of the issue with that as well is the fact that the banks don't actually employ mortgage insurers anymore. Most of the mortgage insurance that comes out these days is self-insurance. So it's not actually insuring the bank against anything that goes wrong with the mortgage. It's just them charging you an extra fee because it can. It's not going towards mortgage payments even. It's just paying them a fee for you having a high-risk mortgage.
Yeah.
Which is, it's not really going to do anything. If you default on your loan, you're going to pay the insurance anyway. And the whole point of that fee is supposed to go to an insurer that then takes counterparty risk for whatever the mortgage risk is that they're taking on. But they're not even insuring themselves anymore. They're just putting it on their own books and pretending that there's no problem. Like, they don't have any loan loss provisions for anything that goes wrong, which is why every time you hear the media say, "Oh, this is a bubble, this is going to go wrong," they don't want to hear it because there's no way they can get out of it. Like, in Canada, the perfect example is Home Capital Group, which last year absolutely crushed it in its stock price. And they basically didn't have any loan loss provisions. So as soon as they started having loan losses on their books, they were basically insolvent.
Well, yeah, they weren't hedging. They weren't properly. They weren't properly hedging, and then it started to come in, and then it came bite them in the butt. I covered home. Me and Mario DeCetti's the Lost Canuck. We covered that Capital Group there when they were begging for bail-ins or bailouts or whatever you want to call it. So, yeah.
Yeah. The one became it today. Yeah. I remember.
Yeah. Yeah. And okay. So, okay. Now, Royal Commission. Why wasn't it put into place 10, 15, 20, why did they just decide? It's like, to me, it's like, okay, I'm gonna get an alarm for my car because my car got stolen twice. It's like, okay, but you've messed up twice. You should have gotten an alarm the first time. Why are they putting the alarm or sounding the bell now when everything got so bad and it's beyond reparation?
Political reasons. The government that's in at the moment is basically hanging on by a thread. You've got in the last 2 months, you've had, well, actually, I think it's the last month. It'd be the last few weeks. Our old Prime Minister got rolled, and we now have a new Prime Minister,
right,
which is the however manyth Prime Minister we've had since 2007. There's no continuity of leadership whatsoever. And there were backbenchers because it's a coalition between the Nationals and the Liberal Party. And the Nationals were agitating for this to happen, and they would have crossed the floor and voted with the opposition had it not have been for the government announcing this itself. It also helped that the executives of the Big Four banks jointly sent a submission to the government saying that we need a Royal Commission. That's the only reason they did it. I think they would have fought tooth and nail against it until either their backbenchers flipped and voted with the opposition, or they didn't get a letter from the Big Four executives of our banks, which is kind of disgusting considering the fact that all the people that are in charge now voted against it over and over and over again, but they also said that they knew of all the issues. And if they knew of all the issues that have come out, then why didn't they tell the public?
Exactly.
If our system is supposed to be so systemically strong, why didn't they say anything?
I wish I could have been one of the auditors there at the Royal Commission, one of the head auditors. I would have gone through everything there with a fine-tooth comb. I would have said, why aren't these paid stubs matching? Why is this SIN number wrong? Why is
they haven't looked at that in the Royal Commission. They haven't looked at it at all. The things that have come out now are not even including that. They specifically excluded the prudential lending in the terms of reference of the Royal Commission here. So we're not even looking at that. I think there's been a bit of agitation for that to be expanded, considering how bad the stuff that they've already uncovered is.
Oh, so we're looking at surface junk.
Yeah, we're looking at the surface level at the moment.
Ooh.
We haven't looked at it in depth at all.
Ooh. Well, you're going to start seeing weaknesses and breaks. That's exactly what's going to happen in the next, with these, especially, I don't know how long you've been watching my channel, but I did a story about 3 years ago, and this is a bizarre one. You ready for this one? UK, I think it was London or some bank, or I think it was in London, or I kind of remember if it was in Middle England. I'm not too sure where in England it was, but they were offering 105% loan to value when you bought it.
That's complicated.
Yeah, that's ludicrous. That's ludicrous.
I think they still offer that in Western Australia at the moment. There's no down payment mortgages in Western Australia still. I'm trying to think where exactly that's really common, but yeah, I saw that because I was in Western Australia. It would have been early March this year, and I was watching the television, and I was just going, "What? Why are you guys advertising no down payment mortgages? You've just gone through a mining boom and you've had a bunch of houses crash. Why would you expose yourself to risk when you know these things can go wrong? It just doesn't make any sense."
It's very dangerous. Very dangerous.
Yeah.
Very dangerous. Yeah. Playing with a loaded gun but if they all know the outcomes, you know what the thing is, and the one thing they're scared about doing, and is having to crawl back the numbers because affordability is not there. So you're in Sydney. Tell us about the affordability there. Are you seeing a mass exodus of younger people leaving?
Absolutely.
Okay.
Yeah, there's a bunch of people from Sydney moving to Queensland because Brisbane is one of the most affordable major capitals.
Yeah.
Like the Eastern Seaboard anyway. There's been a bunch of people that also left to Tasmania.
Hobart, yeah.
to Hobart. But even that's not affordable anymore because if you're renting, the rental yield has gone down way down from what it was even 2 years ago. So that means that either the mortgage payments are really stressful now to people that have just recently bought, or the people that are renting don't really have a great income, because the income difference between Sydney and Hobart is massive. Like, your median income down there is a lot lower than what it is in Sydney.
Okay.
That's not to say that Sydney's not is affordable. It's just saying that if you're comparing house prices and rents and things like that, you've got to compare incomes as well.
Right. That's correct. So, Exodus, have you lost a lot of friends?
Yeah, there's a lot of people that I'm friends with that have moved overseas actually, rather than moving interstate. Like, a bunch of my friends have moved either to America or to London to try and get away from how expensive it is in Sydney, and just the lack of job opportunities as well. If you're not in, like, I've studied engineering myself, but if you're not in data science or software engineering or anything like that, there's basically not that much in Sydney for you. It's the job market's not great.
Okay.
Which is it's a bit weird because you'll hear the government brag about GDP growth 3.4%, unemployment lowest at however long, all these sorts of things. But if you really break it down, let's just break it down. What's more important? Is it more important to have labour force participation, or is it more important that people are applying for jobs? Because if you look at the labour force participation rate, that's not really any higher than what it has been for probably the last 10 years. The US, the labour force participation rate has actually gone down quite significantly. So if the labour force participation rate in the US has gone down since 2000, and they brag about unemployment, it's like, well, your labour force has shrunk 10-15%.
Right.
So there's not as many people that are even in the labour force. So you can brag about less people being unemployed, but less people of a smaller workforce. So
yeah. Well, one thing I realized when I was in the United States, I was in the state of Florida for a while, and I noticed there was a lot of, everybody kind of had their own business there. I noticed that. Like, 1 in 10 people owned their own business, which was really good. That's why you get a lot of people kind of branching out and doing their own thing. And that's why when you go in some states, there's just tons of strip malls, tons of small mom and pops businesses, and there's quite a bit actually. Like, I was surprised to see how much there were. Tire repair places, computer cleanup service, like all kinds, And I think there's a lot less red tape in some states, and some states are a lot less taxed. That's why you had a lot of your friends move to the United States.
Have you heard we always, in Australia, the media there's like 5 or 6 different things they say are reasons why there's not going to be crashes, and I've debunked every single one of them. So I hear a lot.
Okay,
population growth is really high, and therefore we're not going to have a crash because our population's growing so much.
That's a bunch of crap.
I've heard, look at Spain, look at Ireland, look at the Middle East, like Qatar and Saudi Arabia and the United Arab Emirates. All of these places had really high population growth and rising into the GFC. As soon as the GFC hit, their population growth tanked. So it's not something that's a leading indicator, it's a lagging indicator. It's something that's an effect of something, not a cause of something. Because if it was a cause of something, then you would have seen all the countries that had population growth hold up better. And Spain and Ireland certainly didn't hold up well during the GFC.
Right, that's correct.
So that one's gone. So, the next one is we have full recourse lending.
Okay, wait. Number two, say it again. Number 2 was full recourse lending. Yes, I've heard that many times.
Yeah.
Okay.
So the Prime Minister came out yesterday and said, we have full recourse lending, so you can't just hand the keys back when you have issues on your mortgage, like they did in the US. First of all, the US has 38 of 50 states that have got full recourse lending. So when that argument's made, again, is there a situation where it's comparable, where something like this has happened, and you can then say, oh, okay, they've got this legislation, and it's the same legislation as what we've got, and it didn't work there. And there's 38 of 50 states in the US have got full recourse lending. Ireland has full recourse lending. Spain has full recourse lending.
Right.
So that argument's gone. It doesn't work. It hasn't worked in other countries.
Well,
sorry,
but they need to put everybody on the hook because there's a lot of bad stuff being thrown on the books too, and then a lot of people are being misled, right? And I mean,
we do actually have instances where we don't have full recourse lending, but the problem is it's in people's pension funds. It's in their superannuation. There's a thing called self-managed superannuation in Australia where people can buy properties or borrow to buy properties through a thing called a limited recourse borrowing arrangement, which is literally not full recourse lending. And that has grown 50-fold between 2012 and 2017. It grew 50-fold. So when I hear people say, "Oh, we don't have, we all have full recourse lending," I'm like, let me just take you through the bank's documentation where they've advertised the self-managed superannuation funds, where they can get a loan where they're not on the hook when something goes wrong.
Yeah,
which is fine. Like, I actually think that's a good idea, because if they were on the hook, then the contagion would spread to the rest of their superannuation.
Well, but they'd be better at explaining things and properly laying out a better deal too, right?
Yeah, absolutely.
So,
I just think there's a bunch of dishonesty. Like, people aren't actually taking this issue and going really to the brass tacks of whether what they're saying is true or not. Like, you can say something which is partially true, but you then can have counterfactuals which completely blow it out of the water.
Right.
And if there are counterfactuals, then you should put those forward in your argument as well. You can't just present one side.
Yeah.
Like, I'm presenting what's been said and then what has happened in other countries to see whether or not what has been said and what has happened match up, and they don't. So I have questions, or I have issues with what has been said.
Yes. Okay, next, debunk. What's the next one? You gave us the first two. So it was
population growth.
Yeah.
Population growth, lending standards. So full recourse lending. Lending standards is another one.
Yes.
That said, our regulators have come out and said we have a quote unquote unquestionably strong banking system in Australia. Now, I have issues with that again, because half of all mortgages issued by the end of 2014 were interest-only mortgages.
They're called nightmare mortgages.
Well, I can't see how it's mathematically possible that people will be able to service their mortgage when they have to refinance at the end of the interest-only period, which is 5 years. And that means that if the loan was if peak interest-only loan issuance as a percentage of total loan issuance happened at the end of 2014, and there's a 5-year period, it stands to reason that the end of 2019 is when you're going to face. Basically, if there is going to be an Armageddon, that's when it's going to be.
Right, right.
Because of the multitude of refinance activity, plus the fact that all of these people are in a situation where the prices are actually coming down, so they're trying to refinance having lost equity out of their house as well.
Yes. Well, prices down. What are we looking at? 13% down rate so far in the last 11 months?
Depends where you look. There's some pockets where it's down like 20-30% in Sydney. There's other pockets where it's down like 5%. But again, that depends on, first of all, how many people can borrow to get a loan in that area, and second of all, whether or not the government is giving them the subsidy with. So in Victoria, they removed stamp duty for first home buyers.
Right. So
they're giving them a subsidy, and they're also removing the taxation on buying land for first home buyers. So they introduced that like early. It's either late last year or early this year when that came out as a quote unquote affordability measure, which to me is a joke, because it's not really an affordability measure. It's just increasing your borrowing capacity. So it actually pushes prices up.
Yeah, it's like,
which is the exact opposite.
You know what that just reminds me of, what you just said right now? Do you remember when Obama says we're gonna raise the debt limit, but we're not raising the debt limit?
Yeah,
we're not going to borrow more money, but we're going to raise our borrowing limit, and we're going to raise our debt limit. It's like you're just increasing. it's kicking the can down the road is exactly what they're doing with this band-aiding everything. So much bullcrap, underlying crap that's happening, and I keep saying the same thing over and over again. It's like 50 years ago, half of these people would be doing time in prison for some of the crap they're doing. So okay, now what's your other debunked? What have you else?
The other one is that private debt doesn't matter. You only need to worry about government debt. That's one of the big ones that I hear all the time.
Okay.
If you look at, I encourage you to look at this. There's a Bank for International Settlement Statistics browser where they have the private debt, public debt, household debt. They have all that data in one statistics browser. I'll send you a link once we're finished. But they go through each country, and you can look at comparably where all their private debts have been over time, and see whether there's a link between a rising amount of debt and how badly they were affected. So Japan was basically the canary in the coal mine. Like Japan in the 1980s accrued private debt really quickly, and their economy grew massively. And because no one was really looking at private debt, they didn't understand the fact that when you lever up in the private sector, after a while, once you've gotten to the point where you can't lever up anymore, you've got to pay back the debt, and you've got a lot. Like you have a multitude of debt. It's not just how fast your economy is growing. It's how much your economy has to grow to service the debt that you've got.
Right. I call it blended rates.
That's not
yeah.
So in Australia, we have our government debt's about 100. Our government debt's about 40% of GDP, and our GDP is like in Canadian Australian dollars almost parity at the moment.
Yep.
So so that would mean it's like $1.7 trillion our economy.
Yeah.
So we've got like 400 billion of government debt or something like that.
Right.
Which compared to the rest of the world at the moment isn't very much. Like the US is 100% or something like that of GDP, and their GDP is like $18 trillion or something like that.
Yeah, if you look at the total debts in the United States right now is 22 trillion, 21 trillion, and then if you factor in the healthcare and all the other stuff and pensions and stuff, it's just in and around 100 trillion.
Yeah.
So,
yeah. Well, I'm just trying to think because their government debt's over 100% of GDP.
That's
correct. And then private debt is like 150% or something like that.
Right. They're severely overstretched. I could go to debtclock.org.
But it's not a question of nominal debt. It's a question of debt versus their income. Because if your income is growing really, really fast, then you can pay down the debt. But the debt will be less than how much people are earning, so your effective debt goes down.
Okay, I got it right here.
I could have $1 million debt, but I could be earning $1 billion, and the debt I can carry forward forever because it's such a small portion of how much money I have.
That's correct.
Right. So looking at nominally is not necessarily the best way to go about it.
Of course.
Like you can, but you need to also look at the rate at which it's like compared to incomes or compared to GDP or something. You need to have some kind of ratio so that you know whether it's because inflation is always going to make money look more. It's always going to make your debt look more expensive if you just mention the nominal debt because inflation says that debt is going to be even if it went from 400 to 440 and inflation was 10%, then effectively the debt hasn't risen against your income because your income's gone up 10%. You've had it,
yeah. So I'm looking at the gross domestic product right now in the U.S. is 20 trillion.
Yeah.
And U.S. national debt sitting at 21 trillion. And and U.S. Federal tax revenues up actually 68% is at 3.3 trillion.
Yeah.
And I'm just looking at the key ones here. There's lots of them here. Revenue per citizen sitting at 9,125. I remember it was sitting at 1,000 or less than that when like 3 years ago. It was just horrible. So there's a lot of green I'm seeing on this because last time I went on this a couple of years back, everything was red as blood. But I'm seeing
it would have been.
Yeah,
it would have been.
Yeah, everything's in green now. Corporate tax is going. Tariff tax is going at 51 trillion. So payroll tax revenue is 1.1 trillion. So I mean, it doesn't look as bad as it does when you look at the debt clock, but when you start factoring in, and offsetting and taking away and subtracting, it starts to make a lot more sense on a global level.
Yeah.
And that's what we're
Yeah.
looking. Yeah. So
I just sent you a link, and
Yeah.
that link has the Australian debt characteristics in it. So we only ever really look at the blue line on the chart that I've sent you.
okay, you sent it. Yeah, you sent it to me on Facebook, right?
No, it's on. I can send it on Facebook.
Yeah,
as well.
send it to me on Facebook. It's because I got it open here on the side. It's very hard for me to open my. Yeah.
Perfect.
There we
I just sent it then.
Very beautiful. Let's open this up here. Now I want to touch on
So
a
that-
few. Okay, I got it right here. I'm going to put it on my main screen here for everyone to see.
Yeah. So the blue line is what we talk about in Australia.
Mhm.
We don't really look at anything else because the blue line is government debt. So whenever we hear our government, this is the third thing that I like to debunk. Sorry, the fourth thing that I like to debunk
Mhm.
is that we have a quote-unquote government debt disaster.
Okay.
If the blue one is a debt disaster, what are we doing about the red one?
Yeah, I'm
Because
looking
the
at
red
it right
is
now.
got nothing.
Yeah.
The red one is just households and the private sector.
Yeah, I think
The yellow, just households.
yeah, and I'm looking
So,
at the
yeah.
yellow one is households NPI.
Household debt to GDP is the yellow line. We're the second highest in the OECD.
I see
which I'm-
that.
Yeah.
And then the
So the only place that's got higher than us is Switzerland.
Yeah.
But Switzerland runs a trade surplus and we don't.
well,
So we don't have that extra income from balance of trade payments. And they also have low government debt there. So
yeah, and I think I wouldn't say they're happier there, but it's a different style of life. So what I'm looking at here, and I mentioned this in a video I did the other day, that Australia per capita is one of the highest indebted, household debt. It's just phenomenal. It's I can't believe how indebted people have entrenched themselves. When I saw those numbers and I was looking at, I was like, oh my God, I am grateful. Like, I have no debt. I stand on no debt. I have zero debt. And that's why I have so much, disposable income. Because if I had debt, everything I'd make would be servicing what I've borrowed. So, and when you're looking at borrowing, it's almost like you're paying back what you did. And you're still paying back what you did. It's almost like you're not going ahead. You know what I'm saying?
absolutely. The part of the problem that we have in Australia is that the discussion is really, it's in its infancy. It's not really that well established. But I think in the US, it is a lot better established because they went through the GFC or the Great Recession or whatever they call it, and it's humbled a lot of people.
Right.
Like, you can't go out into that situation and come out of it and go, oh, there's nothing wrong with our system.
Debt binging.
There's at least a discussion about it.
Yeah.
Here, we escaped the GFC, so we're fine.
Okay, I got a question for you. Did you go to those? Yeah. Did you go to those parties where everyone was segregated at the big house party, and the people that own houses talked in a group and talked to how great it was, and the people that didn't own houses were in the other group talking about how I hope it crashes? Did that happen a lot?
Yeah, that does happen. Yeah.
Tell us about that.
Well, it's basically an age thing here, because if you're under 40, you pretty much don't own a home.
Right.
There are people that do, but whether or not they can service the mortgage they have is a big question, because a lot of the people that have gotten those mortgage have either used a home equity line of credit from their parents as guarantors. So their parents have said, we'll give you X% of our equity to buy, or as a deposit to buy.
Mm-hmm.
But they don't have wage growth, they don't have large incomes, they don't have large amounts of savings. So it's a question of how long before there's a big shift in unemployment because the banks stop lending, and how long is that going to affect the people that do have that kind of housing? So the people that are my age that have bought in, how many of those are going to be affected by the fact that this is basically they've reached the end of how much the banks can lend. And now the reason why people don't want to talk about it is because obviously, it's a self-interest thing. Like, if I had a loan for $1 million and I knew I couldn't pay it off,
mm-hmm.
and someone comes and tells me that the market's going to implode, then I'm going to be in a really bad situation if I don't get out of the situation that I'm in.
Right.
If I don't want to get out of the situation I'm in, I'm in my own house, you know.
Mm-hmm.
But beyond that, oh, sorry, go.
I was going to ask you: are you feeling? Do you feel it in the air? Do you see it in people's eyes?
Oh, absolutely, absolutely. The mood has changed probably since April this year. In terms of what people's sentiment was. Like, even up to about September last year, people were saying, "Oh, it's just going to flatten, and it will go back up again." And then it started falling a little bit, and then the Royal Commission came in, and the banks have clamped down significantly on how much people can borrow.
Right.
And then people are going, "Okay, it's going to keep going."
And stress testing came into play.
Well, stress testing is a joke. It's really a joke because there's a thing that you can do in overnight markets, which is what the banks in the US were doing all the time. They can they can purchase these short-term contracts, which basically decreases the amount of debt that it looks like they have on their books because they've got a really short-term contract that expires. And once the regulator comes in and does their analysis of the stress on that bank, they'll just offload that contract and go back to where they were.
Right.
So it looks like fine, but they're never actually fine in the first place.
Badly packaged deals is what they are. Badly packaged deals, and they were traded.
Yeah, but it's more to do. So they're like interbank trades or bank to Federal Reserve trades. So
kind of like a residual.
Yeah, basically there's a contract. I can't remember what it's called off the top of my head. I'm going blank, but the Federal Reserve was basically providing them a line of credit so that when the regulator came in and did their stress testing, they would pass, even though the only reason they pass is because the Federal Reserve has provided a line of credit for them at that point to make it look like their debts are okay based on how much equity they have.
Well, they got to keep them in line, right?
Yeah. Well, no, but it's just a way to say, oh, we tested them, everything is fine, even though they're providing them liquidity specifically so that they will pass the test.
Yeah.
So that to me is kind of like, I don't really believe in stress testing in that sense because you can get around it with legal loopholes all the time.
Okay. Let me finish off with the one I wanted to add there. So stress testing is a joke, okay, and the cut off of capital outflows coming in from China.
Yeah, that was probably halfway through last year.
Yeah.
There was the $50,000 limit on how much Chinese people could bring out of the country per year in US dollars.
That's correct.
So it means that they've had to find other avenues to try and launder money, because that's basically what a lot of it was. Is just making sure they can get their money out because they don't trust the value of the renminbi because they don't trust Chinese government data.
I wouldn't trust Chinese government data, would you?
No.
But did you hear?
The unemployment's been the same. Well, the unemployment was the same for like 5 years, from like 2011 to 2016. That just doesn't happen. You don't have the same unemployment rate for 5 years. It might be the same for like 6 months, but 5 years now.
No, it's not gonna. That's not gonna fly.
There's no way that that's even possible. The only way you could have something like that is either if you're just pumping ridiculous amounts of money into the system that's just going to come back and bite you at some point, or if you're lying.
Andrew, do you remember? Speaking of pumping money, do you remember an article I read about a year and a half ago about people bringing duffel bags of money into a casino, buying chips, sitting at the table, and cashing them out 20 minutes later?
Yeah.
Wow. Did you guys have that there in Australia too, or was it just in Canada?
No, I think it was just because our regulation in banking was so bad. You could just buy a house with cash and people wouldn't check.
Yeah.
That was basically what it was. Like, we didn't really have any foreign buyer checking until probably even early last year. So it's been going on for a long time, especially probably since 2012, I would say, is like the big time where it really took off. And then kind of last year is when regulations started coming in a bit more. Like, we had the interest-only speed limit introduced by APRA on the 31st of March last year.
Yes.
And they said, that was a big turning point for me. That was like one of those things like, oh, wow, they're starting to really clamp down on this stuff. But the biggest one out of everything is probably being the fact that banks can't assess how household expenditure using the household expenditure measure. There's this university thing called the household. It was developed at the University of Melbourne, where they basically said, we're going to assess you based on based on how many people are in your house, how much you spend on a yearly basis.
Right.
So that they basically said, no matter how much a household income is, we're going to say it's the same amount for expenditure, which means that the more the gap is between your expenditure and your income, the more you can borrow, which means that the borrowers on the higher end actually leave it up more because they're day-to-day, so non-discretionary expenditure plus discretionary expenditure was measured $32,400 for a family of four.
Okay.
Which to me is ridiculous. There's no way a family of four can spend an entire year $32,400.
That barely buys food for the year.
Yeah, well, say you're insuring your car here in Australia. That's like $3,000 just to get it insured.
Yeah.
That's for one person. Say you've got two cars. That's $6,000 of your $32,400 gone.
Yeah.
Like, just by paying insurance. Plus you got fuel costs. So you pay $100 to $150 a week for groceries, and that's on the low end. That's another, like, $7,000.
Yeah.
Like, you know, you're flying really close to the sun if that's how much they're assessing your expenditure as being.
Yeah, that's.
But yeah, that came up in the Royal Commission, the household expenditure measure being used to qualify loans. And there's actually a case against Westpac, or there's two cases against Westpac at the moment for them having used that to issue mortgages because it's non-compliant with RG 209, which is what I was talking to you about earlier today.
Yeah.
They're not complying with responsible lending guidelines because they're not making reasonable assessments of their cost of living.
That's disgusting. Well, I don't know if you remember the article I read where they assessed him at $10,000 a year. I'm not sure if you remember. I read an article about that.
Yeah, so that's like Henderson Poverty Index levels if they're doing that.
Like, that should be like people should be doing time in a prison because what they're doing is they're taking the total debt service ratio, they're fudging the numbers, they're making it seem like, oh, technically you could live off this, so we can lend you this much in response. In response to what you have, we could give you this. And it's they're just lying through their teeth. And like I said, it goes back to the beginning of the conversation. They're setting up customers with garbage that they don't need. And they basically, back in the 70s, 80s, the when you go to the bank would decline everybody that walked in there, and they're like, oh, my bank doesn't help me. My bank does nothing. You know what? Your bank is helping you when they decline you because they know you're going to default in 6 months.
Yeah, exactly. It also means that your cost of living is significantly lower because not all of your income is going to debt service. Like you can actually spend money on food, you can actually spend money on travel, those sorts of things. Like obviously you're going to probably have more inflation, but the inflation is not going to be in asset prices, so it's probably going to be more evenly distributed because the government then determine how much they're going to spend on certain things, which they'll have more of an income to do because there's more money turning over in the economy rather than just servicing debt.
Okay, now consumer spending. Are you starting to see people losing confidence in?
Definitely. I would say again that's the last 3 to 6 months. Consumer spending is kind of flatlined. It hasn't really. It's not super negative, but there are certain areas where it's gone down quite a bit. Like especially homewares and things like that, like white goods and stuff like that. It's definitely gone down a lot. But I think that's basically because it's tied to how much turnover there is of housing. Like if it's turning over really slowly, then obviously you're not going to be able to sell as much new white goods or anything like that because they're not moving it.
Yeah, you're not moving it. But you know what? It's like I said, people are house broke, plain and simple. They allow these mortgages to go through. And then the person's completely house broke, and then there's no more consumer spending in the middle class because they're tied into these ridiculous mortgages that they thought was good for them. Now they're up the creek.
Yeah.
Okay. Another question: negative gearing being scrapped. Do you see negative gearing in Australia being scrapped?
Probably. Yeah. But that will be determined by the next election. The next election, I think the opposition is going to win by a lot. So they'll be able to pass a bunch of things that they've had on the books for a long time.
Okay.
But negative gearing scrapping is going to be grandfathered, so it won't be retrospective. It'll just be for new. So even with that, there's caveats to a bunch of these things. So they're saying they're going to get rid of negative gearing for existing property. So you can't buy a property that's 50 years old and then negatively gear it, because all the tax deductions from you buying something that's new hasn't added to the property. So the whole point of negative gearing was supposed to be to add to the property stock.
That's right.
It was supposed to be an incentive for people to build or buy new property and then rent it out at a discount, so that there wasn't a big gap between the new property, which was expensive to rent and buy, and old property, which was cheap to rent and buy.
That's correct.
But the problem is,
I see it as
the negative gearing predominantly on existing property.
Okay.
It's not on new property.
Okay. So they scrap it on the new buyers.
Yeah, it doesn't change people's incentive to want to build. The thing that's changed that in the last decade has been how much people have been willing to lend to developers and home buyers to be able to actually build these projects.
Okay, next question. Are they going to raise rates one more time before the end of the year?
The banks, our banks.
Let's start with the reserve.
I don't think they're going to touch them for a long time. The Reserve Bank.
Okay.
They're basically in between a rock and a hard place. If they cut them, they're going to keep stoking the housing market, which is really politically unpopular.
Okay.
Or if they raise them, they're going to put people into mortgage stress, which is basically where they already are. Mm-hmm. So they're basically stuck between a rock and a hard place, and I don't think the RBA is going to do anything.
Okay.
Where the big four banks, I think they'll raise probably once or twice again this year. It depends on what the US does, because the US makes up roughly 35% of our wholesale funding market in Australia.
Yeah.
Because we get a lot of our money from US banks.
That's correct.
And the thing that's gone up a lot in Australia in the last probably 9 months has been the bank bill swap rate, OIS spread. Mm-hmm. So there's a measure for how expensive it is for our banks to borrow from overseas banks.
Right. What's the rating at right now? AAA negative right now?
Our banks are, I think they're AAA negative. Okay. They're either a AA or AAA negative, one of the two.
Okay.
But yeah, they're going to get downgraded, and it will go up and up and up. Okay. Like every time there's something that turns up in the Royal Commission, the equity price of the banks just kind of hovers or goes backwards. Right. But there's like a whole bunch of like layers on layers and layers of this stuff. The banks in Australia are like one of the highest dividend paying stocks you can buy on the ASX.
I made a video about that. I made a big video about that, and I was talking about people's political landscape and how people, the echelons and the very high ups, are riding this wave of dividends that the banks have been paying out to them at 5, 6, 7, 8%, and they're just enjoying life. But they don't look at the political the financial struggles. Their financial landscape is completely different than what the average working person is. So they think everything's fine and dandy and living off these beautiful dividends off these stocks, and the little guy, is getting 0% on his regular day-to-day bank accounts, where it used to be 7% back in the day, where people didn't need to invest because you were getting 7%. Now the little guy's getting nothing.
I think part of the issue as well, there's like 3 or 4 layers to that. You have a thing called dividend, fully franked credits in Australia. So you're not paying tax on the dividends that you get from the banks, first of all. Mm-hmm. Second of all, the dividend payment that you do get is a really high yield. Third of all, the dividend payment is determined by the net interest margin, and that's primarily determined by how much the bank bill swap rate borrowing cost is in comparison to how much they're charging in mortgages and what rate they're giving on deposits. So every time the US raises rates, the bank bill swap rate spread goes up, which means that the bank's borrowing cost here goes up.
Right.
And we also, I think it's the first time since like 1995 that Australia has had lower interest rates than what the US has had.
Yeah, 98 I think it was. 98.
1.5%, 2% now in the US. So, Yeah, that's the first time that's happened in basically most of my life.
Right.
So that's like a third layer thing. And then on top of that, it's the fourth layer is how much mortgage stress do you cause by trying to maintain your net interest margin so that you can offer the same dividend payment to your shareholders. Like, you're introducing systemic risk by raising rates on people that already can't service their mortgages,
Right.
to make sure that your shareholders don't desert you based on the fact that you want to give them the same dividend that you've always been giving them.
That's right, and you want to keep them happy. And the main thing, the saddest part is they're not even lending, and they're not even lending or creating these dividends from deposits. They're just taking it out of thin air.
Yeah, but they can do that because they have a banking license. It's legal. It's perfectly legal for them to do that. It's just a question of, are they doing it ethically, or are they doing it in a way that is shoddy? And I would say it's the latter. I'm not going to say which bank has done what.
I know which bank. I know which bank. I know which bank's in a lot of hot water. Yeah. I made a story about them the other day in hot water.
Yeah.
Yeah. The Big W, right?
What's that?
Westpac, right? Big W. Yeah. So, yeah.
They're the ones with the highest concentration of interest-only mortgages, and they have, I think they're like 85% variable rate mortgages.
Oh,
that's common though. All the banks are like that.
Yeah.
They're variable rate.
Yeah.
Yeah, you can't get a 30-year loan or a 25-year loan in Australia. I think the longest term for a fixed rate mortgage is like 5 years.
Yeah, it's 5-year term and a 30-year amortization, right?
Yeah.
Wow.
So in the US, you can get a loan. Say it's like 4 or 5%. You could get a 30-year amortizing loan with 5% fixed rate, which is really good historically.
Right, it is.
It's really good. Like, I wouldn't mind paying a little bit extra in interest if the price is down significantly, and I know that I have interest rate security. Like, it's not going to change on me.
You just said the key word. You just said the key word. Price is down significantly. I had someone earlier in the comments section say, I'd rather pay 7% for a $260,000 house than pay 1.5% on $1 million house.
Yeah. I think part of the problem in Australia has been the discussion is always between baby boomers and millennials.
Oh, I love that discussion.
Yeah. This is probably global, but the discussion is always, I paid 17 or 18% interest in the 80s on my mortgage. Mm-hmm. And then I'm just like to them, yeah, but your mortgage isn't 1 year, it's 30 years. Mm-hmm. If you've had a variable rate mortgage for 30 years and you got it in the 80s, then it's trended down the entire time. And your mortgage has not just gotten cheaper in terms of how much you paid off it. The interest you've been paying on it has actually gone down the entire time.
Yeah, because the principal's going down.
Yeah, but it's not just the principal going down. It's the principal's going down, but the interest rate being offered by the Reserve Bank is actually going down as well. So
I see. I'm sorry.
Right? So it's like an acceleration of how much... So at the point in time, if they had assumed that your interest rate would be the same as what the interest rate was then, then their assumption of how much you're paying on the mortgage is actually significantly... you actually significantly undershoot that because they're assuming that the interest rate you're going to pay in the entire duration of the mortgage is significantly higher than what has been reality.
Exactly.
Whereas for us, it's like the principal is so high that it's four times the principal in real terms compared to what they were paying.
Exactly.
So it's four times higher. And in Australia, I think up until like the late 80s, they only considered one income.
Yeah.
For a mortgage.
Yeah, up until 87. Up until 87,
it's 4 times higher on the two incomes.
Right.
So, because they consider it as household income, right?
Okay.
It's household income. So household income would be both people now, whereas back then household income was just one income. So they didn't consider the second income as a household income.
Right.
So it's like, so the incomes could have doubled, or not doubled, but you've got two incomes. Right. And it's still 4 times more expensive than the two incomes. So it's really more like 8 times.
8 times
more expensive because there would have been a bunch of women that were working, and their income wasn't counted towards their mortgage payment.
Right. Yeah, of course not. But that's yeah. Those are the golden years when people paid off their houses in 5 years, right? Those are the good old.
Yeah, well, my dad bought his house in 1970, where he is now.
Mhm.
I think he said paid like $30,000 for it.
Right.
And it's just been valued now at like 1.2, 1.3 million dollars, something like that.
Yep.
That's like 40 times what he paid, and inflation hasn't gone up 40 times.
No, it doesn't
So,
because
not even close.
wages and buying power aren't catching up, right? Buying power is the key, and a lot of people.
No,
Don't,
I think he said his income at that point in time was like 6,000 a year, and he paid. Oh, sorry, it was 10,000 a year, and he paid 30 grand.
yeah,
So it was like 3 times his income.
yeah. That's
If that was comparable now, me alone would have to be on like $350,000 a year
yeah.
to buy the same house. Like it hasn't really been. It's an old house, right? Like they haven't really renovated it. It's been paint jobs and stuff, but it's mostly the same infrastructure in the house.
Mm-hmm.
So it's not just the fact of this was a brand new house when he bought it. Like you would have a bunch of depreciation in the actual value of the house as well, beyond just the fact that that it's an old house. Like back then, it was new appliances, new infrastructure, all this like new plumbing, all that kind of stuff. And you look at it now, it's like, well, how can it be worth more if I have to replace all this infrastructure as well? I don't get that.
Yeah, because then you have to put back another 200 large into it just to get it back to more to an updated or code or whatever you want to call it, right?
Probably more than that, actually.
You think so?
Probably more. Yeah.
Oh wow.
Yeah.
So
Yeah.
so
It's not a new house. Definitely not.
okay. So all right, we're getting to our 1 hour here, but before I want to go over a few articles with you real quick here, and you could answer them for us. I got an article that was just posted about 20 minutes ago, and I just give us your outlook on it. Okay, news.com.au is posting our weakest link, Australian suburbs most at risk. What do you think?
Australian suburbs.
Yeah.
It depends on which state. Like, there's obviously pockets that are really badly off, like northwestern parts of Sydney, like Kellyville.
Mm-hmm.
Like, I know where the pockets of stress are because it's mostly where the young buyers are.
Mm-hmm.
So if you look at the median age of the population in that particular area, you can generally tell where the mortgage stress is because they haven't had the time to save up for a deposit. So they've jumped in, having bought within probably the last 5 to 10 years. And they basically can't service whatever their debt is.
Okay.
So I would agree with that, but I think there's some caveats to it.
Okay, good. Next article. Sydney rents drop amid rise in vacancies. What's happening there? Is there more places for rent?
Yep, that's definitely true. Yep.
Okay.
One of my friends recently was told he had 30 days to vacate because the person that owns his house is going to sell where he's living, and he said, "Okay, fine." And within a week of him looking for a place, there's one he'd bookmarked, and the rental rate had decreased $30 per room in like 4 days from what he'd say. So yeah, that's definitely something I've been seeing a lot of. Like when my girlfriend and I moved into where we are, we were paying $560 a week, and the rents went really quickly upwards beyond what we were paying, and they're starting to fall back to what we're paying now, which is weird because the price went up like 30-40% beyond when we moved in, but the rent is now coming down as well. Like I'm talking the prices in how much people paid for similar sorts of dwellings to what we're living in
versus what they are now.
Yeah, so if we're paying this much rent and the person bought before we moved in, and someone's bought a new place and they're starting to reduce the rent towards what we're paying, how are they going to service their debt?
Yeah,
like I'm sure you got negative gearing, but like not everyone has $200,000 income that they can tax deduct off.
Yeah, they could write it off write it off basically.
Yeah.
Okay, next article. The CBA thinks Sydney property values can fall 10%. Posted.
At least more than that.
Yeah. I'm going 20, 30, 40. I'm pushing 40, and a lot of people are like, Mike, you need to see a mental. You need to check into a mental hospital.
I think that's realistic. I think that's realistic.
You know why? Can I say why? It's because what the medium household could afford!
Yeah. I think, well, the affordability, if you were looking at 5 times median household in Sydney, then median household price would be like $580,000 to $600,000.
Yeah, 600,000 really, really in the higher end. Really higher
But
end.
at the peak of the market, it was like 1.1. So from peak, you're looking probably like 40-45%.
Mm-hmm.
But that's like, if it was to come back to affordability, I'm not saying that the government's not going to step in and pump more money into the system. They probably will.
Or
but,
do you think they'll
like,
throw...
I don't know what the response is going to be, so I don't know what the bottom is, but I know it's certainly got a long way to move if there's nothing done. Like, if you just said it, if just given all the regulations now, if they're enforced the way that they are, there's a long way to fall.
Okay, next article. Inviting a crash. PM, Prime Minister, issues ominous warning as he defends government's housing policies.
Yeah, that's the one I was telling you about.
Yeah.
That article where he said if Labor gets in and they introduce they get rid of negative gearing, that it's going to crash the housing market. But I don't think it would just crash the housing market. No. I think the economy will fall over because of how much reliance we have on housing for our entire economy.
Mm-hmm. Yeah, we mentioned that. Yeah, it's basically guys living in Canada and the United States. Negative gearing, just so you guys could understand, it's like a business expense, a write-off.
Tax deduction.
A tax deduction, yeah. We call them write-offs here. And
it's the same sort of thing.
Yeah. So,
but it's not really, it's not really a write-off because you can also tax deduct depreciation as well. Because depreciation is where the value of your capital goes down over a period of time due to wear and tear and things like that.
Mm-hmm, mm-hmm. Yeah.
So it's not just a write-off, it's not a write-down. It's also a subsidy beyond that.
Yeah. And what do you predict for spring is in the air in Australia. I told because winter's coming here. Spring is in the air. How do you see? Do you see great big spring sales in Sydney and Melbourne?
Do I see sales?
Big spring movements that's going to correct the market. What they're predicting.
So normally we get a big jump in the transaction volume in spring.
That's
because
right.
Auctions happen and your clearance rate generally goes up a little bit in spring. It hasn't made a single difference at all that it's spring now.
Mm-hmm.
Not whatsoever. Like last weekend was a perfect Saturday, which is when most of the auctions occur.
Mm-hmm.
And clearance rate was like 53%, and that was like what was reported. So there's like 20% they didn't report, and then of that, a lot of those are getting cleared. So your actual clearance rate is more like 43-45%, which it hasn't. I don't think since I've been looking at the market, I don't think I ever have seen that, especially not in spring. Like it's actually either comparable to what it was in winter here, or slightly lower in terms of the number of transactions. So the thing now, there's a bunch of transactions that are kind of like not occurring. So the property stock is kind of like building up. So it's not a question of whether the prices are going to come down. It's like a look at how many of these have to build up before all of a sudden people panic sell, or they sell at a loss. That's my outlook.
And you know what it is I was reading an article the other day. They were saying that hopefully spring is in the air and the bounce back. The Australian market needs a huge resuscitation, and you know what it is. It's a lot of people that bought at the top that are hoping that this. Yeah, that's what they're hoping. But I know it's not going to happen because consumer confidence and what the RBA has been finding out. Going through these bank portfolios and stuff and starting to find all this junk that you said is just on the surface.
Yeah, it's not even, they're not going deep on it.
Wow. And now what's happening is phenomenal. So once consumer confidence goes out the window, once affordability is out the window, once people start fleeing the major cities for affordability, the politicians...
It's not just it's the capacity to borrow. If you can't borrow, then you can't buy. Like everyone says... Everyone here, that's the other thing that I said, I probably should have said that I was talking about debunking is people will pay whatever they want. Like a house is worth whatever people will pay for it.
That's right.
That's right. That's right. But the caveat is they can only pay for it whatever they can borrow, unless it's a cash sale, which most of them aren't. Mm-hmm. Then they can only pay whatever they can borrow, and if they can't borrow the same amount as what they could 6 months ago, then it's not worth as much as what it was 6 months ago.
Right. So yeah, exactly, and you know why it's got to go down 40%, like you said. It's because that's where the affordability.
I don't think it'll happen nationwide. I don't think it'll be like a 40 to 45% nationwide.
Oh
thing.
No, definitely not. We're talking about Sydney. Yeah. This is Sydney proper.
Yeah.
Hobart can't go down 40%. Hobart goes down 40%. Yeah. The average median house price would be $60,000. So,
yeah.
I mean, it can't. And Perth can't go down 40% any more than it has. The average medium benchmark price in Perth is what, $445?
Yeah, something like that.
Yeah, there's no way. No,
it can. But it's based on first of all how much employment you've got, and second of all how much buyer interest there is. Mm-hmm. If there's no employment and everyone migrates away, like it's not to say, like, you know, you talk about places like Detroit. I feel like Western Australia is very similar to that. It's like a one industry town. Mm-hmm. It's a mining state basically. Mm-hmm. Like they have a bit of tourism, but it's mostly mining.
Yeah.
So if there is a big change in the mining industry, I can't see why it wouldn't go down a lot. Mm-hmm. But I feel like a lot of those losses have already occurred.
Right.
Whether it's a city or not, I'm not sure.
Yeah, because I was thinking a lot of them already occurred in the last 4 years anyway. And I think it's starting. I think the housing in Perth is starting to adjust to what the median income should be at. I guess, if that makes any sense.
Yeah, it's still hasn't bottomed, I don't think. But yeah, it's certainly a lot closer to affordability than what Sydney and Melbourne are. Mm-hmm. Mm-hmm. Sure.
That's fantastic. Well, Andrew, man, it's been an absolute pleasure giving us your professional insight, boots on the ground. And one quick question: Q1 of 2019, what do you see happening?
In Australia, I see there being a lot more defaults. I think we're probably going to have interest rates probably 0.5% higher at the big four banks, probably more than that at the smaller lenders. I think there's going to be a massive shift towards securitized mortgages rather than the ones that are just on the bank books. Mm-hmm. And of those, you're going to start seeing a lot of losses in the non-conforming residential mortgage-backed security portfolios, which is weird because the yield on the prime residential mortgage-backed securities has started going up, but the yield on the subprime basically is non-conforming. So like things that aren't prime, they call it non-conforming, but that's basically what it is.
Yeah,
it's basically a prime. The yield on those is going down, which to me is really strange because you would think that if it's supposed to be the way that tranches work in mortgage-backed securities, then the defaults would occur first at the lowest quality, which is like your subprime lending, or non-conforming, which is like
shadow lending,
between prime and subprime.
Yeah, shadow lending, a lot of shadow lending and
so
sketchy.
There's a company called KKR, the private equity company KKR.
Yes, I've seen them.
They took over one of Australia's non-bank lenders called Pepper Money. Mm-hmm. And Pepper Money, they used to be listed on the ASX.
I read an article about these guys. This is good. Tell us. Keep going.
So every 6 months, they used to issue a mortgage bond called a PRS.
Right.
So it'd be PRS 20, PRS 19, PRS 18, etc., based on how many that issued. But the problem with that is that their entire market capitalization when they were acquired by KKR was $500 million. Mm-hmm. Now, the most recent non-conforming residential mortgage-backed securities that they've issued is $1 billion. So it's twice their entire market cap in one mortgage bond issuance. Whoa. And they were doing that for years. Like, how can you issue something that's like double your entire equity valuation in one bond?
I think let's give it a name. I think it's called fractional reserve dissection reserve, double fractional reserve lending.
I don't. It's got nothing to do with reserve because all their money's coming from overseas.
Right.
Most of the investment in that was European lending.
I know. I'm just joking.
Yeah.
I'm just joking.
There's dumb money in the system. Is basically what I'm saying.
Yeah, there's too much shadow. We call them shadow lenders and dark money.
We call them non-banks, but yeah, it's the same thing. Because they're not regulated by things like APRA and ASIC.
Right.
Well, they were when they were listed, but they're no longer because they've been taken over. Like they're SEC regulated, but SEC doesn't encroach on the regulations that we have in our market. So
yeah,
we don't really know what percentage of loans they're issuing that are interest only. We don't know whether they're qualifying them based on prudential lending, all that kind of stuff.
How many people are trapped in that Pepper thing?
I don't know. I know they've become really popular basically since the beginning of last year, but I think that's primarily because all the interest-only loans that people are sitting on, they can't refinance anymore. So they've taken them off to non-banks, which I think is probably what you would be experiencing there as well. Like you'd have people that have got loans that are questionable and they can't get them refinanced because the bank's saying, we don't want to touch you with a 10-foot pole.
Here's the stress testing is a big deal. Stress testing in Canada is actually very strict. They don't Mickey Mouse it. They go through regulated guidelines and stuff. So they don't Mickey Mouse that. So the stress testing, and never mind the rates going up, it's the stress testing now that's been implemented now for the last 15 months here in... I
really want to have a look at how that is broken down to try and understand each component to see whether or not there are ways that people can sneak around it. Because
there is corporate numbered companies and... weird stuff. You could shell companies and all kind of Mickey Mouse stuff. Yeah. I've seen.
Well, that's a tax avoidance thing. Basically, most of the time you'll see shell companies for tax avoidance.
Yeah.
But
yeah. Okay. Well, you know what, Andrew, it was an absolute pleasure having you on the show, giving us your professional insight there. And I'm very sure we're going to have a lot of questions for you. And if you ever want to be, I would love to have you again on the show. And we'll
sounds good.
We'll pull up a few articles and we'll go over a few graphs if you like. If you want to get more technical, we can, and we can get into more nitty gritty essentials in the market. There's just so much underlying crap from the appraiser to the land value assessor from oh my god, from when the customer walks in and speaks to the lender, then the branch manager, then the underwriter.
Every step of the loan issuance chain has got fraud or systemic in it.
It's garbage. And you know what the sad part is I keep bringing up this barber thing. You go see your barber, you give him $20 or $10, whatever you pay to cut your hair. You're giving him you confide in him to not screw your hair up, and you're paying him, right?
Yeah.
And people go into their banks the same thing with that barber mentality, thinking, I'm gonna trust these guys because they have their education, they know what's best for me, and they'll take care of me. And meanwhile, they're just screwing them around.
Well, I think the biggest issue is the discussion around supply and demand, right? Mm-hmm. Like always, whenever I hear people talk about housing, it's supply and demand, but they always say, "Oh, we always need to build more. We need to build more." Where's the demand coming from, right?
Yeah, exactly.
If you're trying to satisfy demand, you've got to quantify where your demand is coming from. Like, is it coming from the banks being able to issue more mortgages? Is it coming from foreign money? Mm-hmm. Is it coming from owner-occupiers that all of a sudden want to move out? Like, they have very different debt characteristics, and you'd be able to see them on a macro scale if that was how demand actually worked. Like, demand is not the same as me going to the corner store and buying a bar of candy because I'm paying cash. I'm not borrowing. So the difference between supply and demand in that instance is there could be 100 people that go into the store and buy that bar of candy, whereas how many people are going to go in with cash and buy X% of the entire property markets? It's a ridiculous argument in that regard to try and compare the two things, because they're vastly different. Like, one relies almost solely on credit supply, and the other one relies on people wanting to buy candy. So,
right.
It's the same thing.
It's basically consumable. It's a consumable, and versus I see where you're going on this, on the two sides of it.
Yeah.
I know the supply and demand is the biggest crock of poop that you could ever break out.
I'm not saying it's not supply and demand. I'm just questioning where the constituents of supply and demand come from, because it could be demand for credit, right?
Exactly.
It could be,
Yeah.
it's not,
I know what you're saying. I'm talking about because you know why I kind of
the discussion is crap. Like what's being said about it is garbage.
Yeah.
Because it doesn't take into account what actually happens in the real world.
Yeah. What really kind of throws me for a curveball is okay. There's a huge supply and demand issue issued in L.A. County, okay, in Los Angeles, but they're not taking into account the 160,000 empty homes that are owned by private investors.
Yeah.
So of course there's obviously 160,000 times 3 displaced people.
Yeah.
If you average 3 person to a unit, that's a lot of displaced people in LA County alone.
Yeah.
So San Diego is
the numbers to Sydney. Sydney's got like 100,000 empty apartments or something like
104,000 that they know of.
Yeah.
So 104,000. That multiply that by 3 people to a unit. Okay.
It's half a million people almost.
It's so much. It's so many people that are displaced. That's why everyone's just saying, "Screw you, I'm leaving." You know what I'm saying?
Yeah.
But you know what? Next time we're on the show, maybe we'll break down a whole supply and demand thing and kind of maybe we could together break down the entire vacant home issue versus vacant homes and see what really is happening in that, because that's one section of the show that I don't talk too much about. I know the mayor in London is taking up all the green spaces to build more laneway cottages and homes. And I don't know if you saw him on the news a few weeks back. We got to take our green spaces back and build more. Build. Yeah.
Yeah. Okay.
Yeah. So.
Yeah. I wasn't aware of that.
Yeah. That was an article I read back about 8 months ago, and it's disastrous. Disastrous. And you see how the pattern, Andrew, are you seeing the pattern how it's happening in every single English-speaking country?
Yeah. Well, it's based on where the credit flows, right? Like, where is the money coming from?
Mm-hmm.
And why is it going to these English-speaking nations? It's primarily because that's where it's easiest to transact, and people don't have a language barrier. So,
and it's more of a trusting government.
Yeah, of course.
Yeah.
We're way too trusting. I don't think Australians are trusting of government anymore. That kind of has gone by the wayside probably in the last 3 or 4 years, sort of thing.
Oh.
But, yeah.
Okay. Well, we'll keep you on the pulse. You're gonna have probably a ton of questions in the comments section after this thing goes up later tonight.